Good afternoon, dear learners. We are here to discuss a very important topic, that is international trade financing. This is part of course International Banking Management. The course code is MMPB 002. So, today we will discuss about what are the various methods of financing international trade. Before that, let us see what is international trade. International trade is basically the exchange of goods, services and capital between countries. It involves both exporting and importing. There are various advantages of international trade, which includes the economic growth, which is basically due to increase in the gross domestic product, number one. Number two, it generates employment in the countries which are involved in international trade. There is access to resources, various resources, maybe it is physical resources, financial resources or human resources. International trade also enables technology transfer between the countries, and it also leads countries to achieve competitive advantage through specialization. Friends, let us come to introduction to international trade financing. So, international trade financing basically is related with, it is a financing mechanism to support import and export transactions. Its importance is that it enables global trade operations, and it also addresses risk and liquidity issues in international trade. It involves and includes various financial institutions and instruments. Now coming to what is the objectives of this particular session, that is, we will understand key concepts in international trade finance, number one. Number two, we will explore common trade finance instruments. Number three, we would like to identify risk and risk mitigation tools. And last one, in the last we will analyze the role of banks and financial institutions. These are the importance of trade finance, friends. Number one, it facilitates smooth international transactions. Number two, it reduces payment and delivery risk, which is also known as default risk. It ensures liquidity to both exporters and importers, and it also helps in strengthening international trade relationships. Let us see who are the key stakeholders in the international trade. Number one is exporter and importers. Friends, the sellers and buyers in the international trade are known as exporters and importers. Sellers are exporters and buyers are importers. Number two key stakeholder is commercial banks and trade finance institutions. Number three is there are certain export credit guarantee agencies which operates in the international trade finance. And last one is there are various insurers. They may be marine insurers, they may be credit insurers and logistics providers. We know the lot of international trade is basically done through the marine or through air cargo, there are through airways. So there are various insurers and logistics players which basically provides the logistics services also. These are the various modes of payment in international trade. Basically, number one is advance payment, number two is open account, number three is documentary collection, and last one, which is very important, friends, is letter of credit, which in short is also known as LC. This is one of the most popular instrument which is used in the international trade. Now let us come to these instruments one by one. The number one is advance payment. Let us see how advance payment is done. Number one, buyers basically they pays before shipment. Number two, in this case, in the case of advance payment, risk lies with the buyer, and basically this type of advance payment is preferred by the exporters because the exporters they receive amount in advance. And last one is, this is used when buyer's credibility is uncertain, because sometimes when we do international trade we do not know the credit you can say credibility of the buyers, because the buyers is located in a country where we as an exporter may not have much of the knowledge. So this is advance payment is preferred in the case where there is the lack of credibility of the buyers. Now coming to the open account. What is the open account? Open account is the process where the goods are shipped before payment. Number one. In this case, the risk lies with the seller or exporter in the case of international trade. But it is suitable for trusted trade partners and often supported with insurance or guarantees. So open account, friends, is done between the exporters and importers having cordial relations, where the exporters and importers they know each other. If there is lack of credibility among them, the open account method will not be used. Now there is a third method which is known as documentary collection. So documentary collection means here basically bank as an institution act as intermediary between the exporter and importer. The documents related against payment or receipts are basically collected. There is lower cost. These documentary collections have lower cost than letter of credit, because letter of credit is the most suitable, you can say, form of instrument which is used in international trade. It is more secured and it involves less security than LCs. Because why it is cheaper? Why documentary collection is cheaper than the letter of credit? Because it is not as much secured as LC is. Now let us see what is letter of credit. Letter of credit, which I have already discussed, that it is the most suitable form of instrument which is used in the international trade. In the case of letter of credit, it is issued by buyer's bank to seller. Number two, it guarantees payment upon compliance with the terms and conditions, and it reduces credit risk. Credit risk is also known as payment risk or default risk in the international trade. Credit risk occurs when the you can say the buyer is not solvent, or it is not it becomes bankrupt. And number fourth is, it is subject to the UCP 600 rules. So letter of credits are basically subject to the UCP 600 rules. They are governed by that. Now let us see what are various types of letter of credit. Number one is revocable and irrevocable letter of credit. What is revocable letter of credit? Revocable letter of credit is a LC which can be cancelled by the issuing bank at any time without prior permission of the beneficiary. Whereas in the case of irrevocable letter of credit, it cannot be cancelled without the permission of the beneficiary. So irrevocable letter of credit is considered to be the most secured LC, because the prior permission of the buyer or importer is required in this case. Number two is confirmed or unconfirmed letter of credit. So what is the confirmed letter of credit? It is here in the case of confirmed letter of credit, a second bank, usually in the case of export and import, guarantees to the LC issuing bank. It is a confirmed means a second bank also confirms, it gives the guarantee that the payment will be done on time. Whereas in the case of unconfirmed letter of credit, there is no guarantee from the issuing bank. Let us see what is sight and usance letter of credit. Sight letter of credit is a letter of credit where the payment is made as and when the documents are presented to the issuing bank. Whereas in the case of issuance usance letter of credit, it can be paid in the later date also. So the difference is, in the case of sight LC, the payment has to be made as and when the LC is presented to the issuing bank. Now let us see the fourth kind of letter of credit, that is transferable and back-to-back LC. So transferable LC is a LC where the beneficiary has a right to transfer the part or full letter of credit to the third party. It means the LC can be transferred by the beneficiary to any third party. Whereas in the case of back-to-back letter of credit, it allows original beneficiary to make one is issued. In the case of back-to-back letter of credit, one is issued to the intermediary and another LC is issued to the supplier. Means there are two, you can say there are two times issue of letter of credit. Number one is issued to the intermediary and another is issued to the supplier. Friends, now let us see what is the process flow of a letter of credit. That is, in the case of letter of credit, buyer requests LC from issuing bank. Number one, advising bank inform exporter, and exporter ships goods and submits documents, and in the last case payment made upon the verification of the documents. So this is the process through which the letter of credit basically works. Now let us see, friends, what are the various trade finance instruments. So first we have already discussed that these are the letter of credit. So letter of credit there are various kinds of letter of credit which we have already discussed. That is confirmed letter of credit, unconfirmed letter of credit, transferable, back-to-back letter of credit, and revocable, irrevocable, and sight and issuance letter of credit. So these are the various letter of credit which we have already discussed in the previous slide. Now there is also bank guarantees. Bank guarantees also play very important role in the international trade financing, because here the banks act as a guarantor. How bank act as a guarantor? Bank basically takes guarantee that if there is any default from the buyer side, the bank would pay the amount. So bank guarantee for this particular service, bank also charges certain fees. So it is not free of cost, friends, and basically bank guarantee ensures the exporter that payment will be made on time even though the buyer defaults. Buyer here means in the case of international trade of credit is importer. Now third is trade credit insurance. Friends, like we know, there are various kinds of insurance policies. There is life insurance, there is general insurance, and one of the general insurance which is very popular among the exporters and importers is marine insurance. And another insurance you might be knowing that there is an institution known as Export Credit Guarantee Corporation of India Limited. I am repeating the name, Export Credit Guarantee Corporation of India Limited, which is in short known as ECGC of India Limited, which provides two types of facilities to the parties involved in international trade. Number one, it provides various types of insurance policies which covers the commercial risks and political risk and other type of risk also. And number two, it gives guarantee, because its name is credit guarantee. It provides guarantee, it gives guarantee to the banks that you can park loan to the exporters or importers, and we are here to back you. So Export Credit Guarantee Corporation of India Limited is only one institution in India, single institution you can say. It has a monopoly in that case, which provides various types of insurance policies to the exporters. So this is a very unique kind of institution, friend. There is no competitor till date in India, which was established in the year 1957. So ECGC of India Limited basically provides the trade credit insurance policies also. Now there are two things, that is factoring and forfeiting. These are two facilities which are available to the exporters and importers also, which is basically used in the international trade. Factoring is the sale of receivables to a third party. There is not much difference between factoring and forfeiting, but the factoring is basically done where the credit is supplied for less than 180 days, whereas forfeiting services are provided by the forfeiter. The organizations which provide the factoring services are known as factors, and organizations which provide forfeiting services are known as forfeiters. So factoring is sales of receivable to a third party, and forfeiting is selling of not only the medium term receivables but also the long term receivables. Here there is a basic difference, that in the case of factoring, the time limit for the credit is 180 days, whereas in the case of forfeiting it is 180 days to 7 years. So for short term purpose, forfeiting services are basically used, and if the credit is for the long term, the forfeiter basically provides the you can say the services, because both factoring and forfeiting improves the cash flow and liquidity in international trade. How cash? Because the factoring organizations, they discounts the bills and provides credit to the exporters. They can discount their bills, and friends, forfeiting services are only available in the international trade, whereas factoring is available in the domestic as well as international trade. In the case of factoring, there are various kind of factoring services. These are recourse and non-recourse factoring, domestic and international factoring, and open and confidential factoring. These are the different types of factoring services which are available in the international trade. So these basically factoring and forfeiting are used by the exporters to basically reduce the credit risk, which is also known as default risk, because the most important risk, most pertinent risk which is there in the international trade is credit risk. So the importers as well as exporters, they can avail the factoring or forfeiting services as per their requirement, and these factor organization or forfeiters, they also provide credit related services. If an exporter wants to know what is the credibility of the importer which is located abroad, the forfeiters and factors, they charge some money and they provide such kind of facilities to the exporters also. Friends, now coming to the role of banks in trade finance. Number one, it provide credit and working capital. Friends, there is difference between a financing institution and bank, because banks only provide working capital, fulfills the working capital needs of the exporters. What is working capital? Working capital is the capital which is required for day-to-day working of the organization. As far as the formula is concerned, working capital is equal to current assets minus current liabilities. So this difference 75, mostly there is a thumb rule that 75% of the working capital requirements can be financed by the commercial banks. Okay. So number 2 is these banks also issue guarantees and letter of credit, because we know whenever trade is done in the international level, the transactions are basically executed through the banks. So importers have their own banks and exporters, they have their own banks. So the receipts and payments, because the bank is a financial intermediary, it also act as a payment institution. So the banks basically facilitates the international trade by helping the importers and exporters by providing the letter of credit. They also issue the guarantees and all that. Now they also facilitate currency exchange, because friends, we know what is exchange rate. Exchange rate is the value of one currency in the terms of another. Let us see, if rupees 100 is equal to $1, it is an exchange rate between rupees and dollar. Okay. So in the international trade, because different currencies are involved, foreign currencies are involved, the receipts and payments are made through the foreign currencies. Foreign currencies are involved. So the banks also act as a facilitator by exchanging the currencies. Now they conduct document verification and risk assessment for their clients. There are various kind of, friends, risk in international trade. Number 1 is country and political risk. What is country and political risk? We know there are many countries which may default, because there are various countries which may default due to their economic issues. We have seen the case of Venezuela. We have seen the case of Afghanistan. So what is the risk? There is a risk in conducting international trade with these countries, because they don't have the good GDP growth rate. They don't have they have not utilized their resources up to the optimum level, and they are basically the third world countries. So whenever the international trade is conducted between the countries, the exporter usually tries to evaluate the position of the countries on different parameters. It may be economy, it may be industry, it may be at the company level, but there is country and political risk here. Means there may be, if we are conducting business, international trade with the other country, and if coup occurs, if there is any coup, military coup is there, that will be considered as political risk. If let us see, if a country has a government which supports capitalism, but ultimately what happens, there is change in the government and another government comes into action, and it tries to confiscate the assets. So in that case, there will be political risk. Another kind of risk is credit and payment risk, which we have already discussed. This is also known as default risk. And third most important risk is exchange rate risk, which occurs due to exchange rate fluctuations. There are various, friends, you can say, factors due to which exchange rate fluctuates. Exchange rate fluctuation occurs because of the change in the interest rate, inflation rate, their balance of payment issues, or there may be issues which may be related to the political events, which I have already discussed just before, and there may be exchange rate fluctuations due to trade balances. Trade balances means maybe on the current account or on the open account as far as the balance of payment is concerned. So these are the factors which basically leads to exchange rate fluctuation. Now there is also transportation and compliance risk, because in international trade there is lot of threat while transportation. So these are the various risk mitigation strategies. One is we can use letter of credit and credit insurance for mitigating the risk. We may use hedging against currency risk and due diligence on trade partners. Before conducting trade with the other parties, we may go for the due diligence, and We may diversify our markets and clients in order to reduce the international trade risk. These are the export credit agencies. They provide risk insurance and funding, support national exporters. Like example is Exim Bank is there, Export Import Bank of India, which was established in the year 1982, the Apex Export Import Bank, and it also these ECAs also reduce political and commercial risk. These are the emerging trends, friends, in the trade finance. There is a lot of fintech revolution going on in our country. Sustainability linked finance, which is also known as green finance. Digital trade finance and blockchain is there, and supply chain finance integration. Now, this is the summary that trade finance is critical for global commerce. Various instruments can be used, which I have already discussed, to manage risk and liquidity. And banks and ECAs, export credit agencies, plays a central role in mitigating risk involved in the international trade. Friend, this is all from my side, and thank you to all of you for patience listening. Thank you so much.